Hi, I am Vipul Mittal, and in this session, I will discuss loss contingency. A loss contingency is an existing condition, situation, or circumstances involving uncertainty. Very important aspect of a contingency is uncertainty. So, a loss contingency is an existing condition, situation, or set of circumstances involving uncertainty as to possible loss to an entity that will ultimately be resolved. So, this uncertainty will ultimately be resolved when one or more future events occur or fail to occur. So it is an existing condition. It is not a future condition. It is not a future situation. It is an existing condition and it involves uncertainty. Right. For example, you sell a product to customer A. So you sell a product to customer A and the product is faulty. Because of this, customer A suffers damages, customer A suffered losses, and customer A files a lawsuit against you and claims $600,000 as damages. No, this is a loss contingency. This is an existing condition. It involves uncertainty. That is, you are not sure of the outcome of the lawsuit. What will be the outcome of the lawsuit? Whether you will win this lawsuit or whether the judgment will be against you, you're not sure. You're not sure of the amount of damages in case you lose. You're not sure what will be the amount of damages. You're not sure of the timing of judgment. So there is an uncertainty regarding outcome of the lawsuit, amount of damages, timing of judgment. In this example. So this involves uncertainty. So a loss contingency is an existing condition, situation, or circumstances that involve uncertainty as to possible loss. So regarding this loss, whether you will incur the loss or not, what would be the amount of loss? When you will incur that loss? That will ultimately be resolved. So this uncertainty will be resolved later. It is not that it will continue forever. When it will be resolved, for example, when judgment comes, that is when one or more future events occur, when judgment comes. I give you another example. So you own a building and government has declared its intent to acquire your building. So there is a threat of expropriation. There is a threat of expropriation. That is, government may acquire your building. Government has declared its intent. No formal order has been passed yet, but government has declared its intent to expropriate your building. Your building may be acquired by government and you may incur a loss because of this, because government will pay you some compensation for this, but that compensation is less than the carrying amount of building. This building has a carrying amount of $600,000, but government would pay only $100,000 as compensation. So this is an existing condition, government's intent to acquire your building. And it involves uncertainty as to possible loss. Yes, your building may be acquired, may not be acquired. If acquired, government may pay you a compensation of $100,000 or maybe higher or lower. So you are not sure of the amount of loss. You are not sure of the timing of loss. But when will government acquire your building? Now, based on probability threshold, loss contingencies may be classified as probable, reasonably possible, or remote. So you classify loss contingencies as probable, reasonably possible, or remote, and this is based on probability threshold. On the basis of probability threshold, what is the probability of loss? So what is the probability of loss? Is it probable, reasonably possible, or remote? When we say probable, we mean, is it likely to happen? Is it likely? Remote, chance of occurrence is slight. Reasonably possible. That is, chance of occurrence is more than remote, but less than probable. So intermediate situation. The chance of occurrence is more than remote, but less than probable. Right. Now under US GAAP, no probability percentages are specified. So US GAAP does not specify that, okay, if chance of occurrence is more than 90%, it is probable, or if it is less than 10%, it is remote, or if it is between 20% to 80%, it is reasonably possible. No, US GAAP does not specify that. So loss contingencies may be classified as remote, reasonably possible, or probable. Now, two questions. Whether any accrual of loss is required or not, and whether disclosure in the notes is needed or not. And it depends upon the type of loss contingency it is. If it is remote, then no accrual is needed, and also no disclosure is required. But if it is reasonably possible, then disclosure is required, but no accrual is needed. No need to accrue the loss, no need to record the loss in the books. So disclosure of the nature of contingency is needed. So you include this disclosure in the notes. And now if it is probable, then you accrue the loss if it can be reasonably estimated. So disclosure is needed. But what about accrual? Yes, accrual is required if the amount of loss can be reasonably estimated. When we talk about accounting and reporting for loss contingencies, you see the classification, you need to see the probability of occurrence. So if it is remote, no accrual, no disclosure. If it is reasonably possible, no accrual, but yes, disclosure is needed. And if it is probable, disclosure is needed and accrual is required only if the amount of loss can be reasonably estimated. If you can reasonably estimate the amount of loss. So there is a loss contingency and chance of occurrence is probable. And the amount of loss that is reasonably estimated is $60,000. This is the amount that is reasonably estimated. You have to accrue the loss. How do you accrue the loss? Loss debit $60,000 and you credit estimated liability. This is the journal entry that you will do to record this loss. And how you estimate loss? Basis information that you have, basis experience. Sometimes you need help of experts to determine the amount of loss. If the amount of loss is a range, so you have reasonably estimated the amount of loss, but it is a range. So it may range from $40,000 to $80,000. It can be any figure in this range. It is a loss contingency and loss is probable, and the amount of loss is a range that is 40,000 to 80,000. Then what amount you should accrue? You have to record this journal entry. What amount you should accrue? So the loss can be $40,000 or $50,000 or 55 or 57 or 60 or 62. It can be any amount in this range. Then what amount you should accrue? You should accrue the amount that is better estimate than any other estimate within the range. But if you say that the chance that loss is $70,000 is high, so $70,000 is a better estimate than any other estimate within the range. And you will accrue $70,000. You will record this journal entry. Loss debit $70,000, estimated liability $70,000. Because $70,000 is a better estimate than any other amount in this range. But if you say that no amount in this range is a better estimate than any other amount, that is, all the amounts are equally likely. You cannot say that, okay, chance of $70,000 loss is high or chance of $50,000 is low. No. Any amount of loss is possible in this range. If no amount in this range is a better estimate, then accrue the minimum amount in the range. And the minimum amount is 40,000. Lower end of this belt, lower end of this spectrum, lower end of this range, accrue that amount. And how you accrue? You record this journal entry, loss debit, estimated liability credit. Because no amount in the range is a better estimate than any other amount in the range. All the amounts are equally likely. You accrue minimum amount in the range. Minimum amount in the range is $40,000. You accrue this. All right, students. I hope this session was helpful in understanding loss contingency. Please do watch my other videos on contingencies to get a complete understanding on accounting and reporting for contingencies. We'll connect again. Goodbye.